A candlestick has 4 parts and it tells us about the trade in something. It gives us an idea of the price during a time period. So during a time period, it must start. That can be any time, 12 p.m., 1 p.m., 12:32 p.m. So we draw a line to indicate the start of the candle. So that would be the open, as you can see here. Then after that, the price is going to move within that time period. And it can do that either up or down. If it moves down, then you start drawing this right here, which is a line indicating the price moving down. The absolute lowest point becomes the low. So you have an open and then a potential low. Now, of course, the price can move up during that time period as well. And so that is also drawn on as a line upwards. That's telling us that the price is moving up. And of course, the absolute highest price during that time period is given as the high. That just is shown by these lines. So you have the open, you have a potential low and a potential high. Now, with a time period, that time period needs to end. And you can choose when that ends. It's either 5 minutes later, an hour later, or an hour or a day later. And when it does end, then you draw another line to indicate the close. Now, whatever price that the asset is at that time, then you draw that as a closing price. So what you have is you have a high, a low, an open, and a close, and that is a candlestick. Simple as that. It just gives us a price from the start to the end of a time period, the high and low, the open and the close. And then if the close is above the open, you obviously put it in green because the price moved up. From the open all the way to the close is an upward move in the price. And so we indicate that via green, or you can do black and white as well, whatever you want. Now, obviously, the next time period starts. The next time period will usually, but not always, start at the same price level as the previous time period closed. It doesn't have to, though. There can be a gap in between time periods, but usually it will start right on, so be around the same price. So you draw a line for the open, which would be here. Then you draw a potential high price during that time period. You obviously track the price down to the lowest point as well. So that would be the low. And then you close it off whatever price it is at the end of the time period. Now, as you can see here, because the open was actually above the close, we're going to color it in red. So you can do different colors, but red and green is the most used. This is very different than a line chart that just gives us a price at different time periods and doesn't give us any trading information. Trading information is what we get with candles, and that's why we use them. In this candlestick course, I'm going to go over the pros and cons of using candlesticks and how traders use them to try and understand the price movements of traders over the short term, how to use them for entries when you trade, and how to kind of avoid some of the pitfalls of using candlesticks as well. If you want to learn more, we have a Discord group. I'll link that in the description below. I'll pin it as a comment. It's completely free. Come and join. I'll also link some other helpful videos in the description as well about day trading and how to read markets and everything like that. They're all free, so I'll list them in the description. Also, if you want some deposit bonuses on some various trading platforms, I use Bybit right here. They'll give you up to $4,000 in your futures trading account if you go ahead and use the platform. But you can use these platforms to actually get some really good tools for free as well, so no harm in signing up. Also, Crypto Investor course, if you want to learn more about trading itself and some of the background more than candlesticks, because there's a lot more, I'll leave that linked in the description. Got hundreds of videos on trading cryptocurrency, but it also works for other trading as well. We have specific videos on options and futures as well, which if you are day trading, then you might be using with crypto as well. So I'll leave all of that in the description, and other resources, everything will be down there too. Candlesticks are the preferred method for traders to understand where buyers and sellers are trading the price of something. And the fight between them gives us an idea of who's winning, and that lets us predict potentially what's going to happen in the next time period. They also give us really good a good view into potentially where the price may flip and change, or how large a move is. Price isn't going to tell us that, but what we want to see is the change in price. That gives us more context. So it keeps track of the price action of traders during a chosen time frame. It helps us to truly know how buyers and sellers are trading in real time. A price does not give you that, but what this gives is the volume, the volatility of the move. And so we can use these to our advantage to try and predict what's going to happen over the short term. They can be analyzed to help predict the direction of trade. Here's what I mean by this. So this is potentially bearish price action that we can see from candles. So bearish price action, obviously you would expect the price to move down, but it gives us more context. So for example, what you can see right here is that we have a red candlestick on the left-hand side. That means that we know that the open is right at the top because the candlestick finished below. So the close is obviously right here. This is obviously a bearish candle, right? Because the price went down, it's red, we're seeing a large move to the downside. What we're also seeing though, is that this is the high price right here. So when the candle opened, it opened at this opening price, it actually went all the way up here. So during this hour time period, for example, the first 10 minutes, actually you might have seen buyers come in and push the price up. So you may have thought, oh, this is maybe possibly a bullish move. But you had this entire bearishness that pushed it way down below the open price and then way down to this low. So this is obviously just a bearish candle. There's nothing positive to be gleaned into this candle. On the second example here, more bearish candles. So you have 3 bearish candles in a row, and let's say what each one of these is 1 hour. So you've got 3 hours essentially of lowering prices. So what you can see here is that, you know, this one opened up here, buyers pushed it up, and then sellers came in and pushed it all the way down to actually close at this price. Now, what we can do is try and predict what will happen in the next candle. If buyers came in and pushed it up here, but then pushed it all the way down when sellers came in to this close, we could suggest that in the next hour and the next time frame, that selling may persist because buyers do not change their trade when the hours change. And so what we can do is predict that if this candle, just on an arbitrary time frame, is going lower, we could predict that those sellers haven't just finished because the hour is up, and they may be selling into the next candle. And so that's where we try and predict this move. What we can see here is this second move is that it's just a bearish candle again, but there is some buying into the selling, as you can see here. So during this time period, it actually came here and then got forced up. Now that could also move into the next candle, and it did. You can see that we actually opened up here, buyers pushed it up a little bit further. So you can actually use different time frames to see where trade is happening during those time frames and make some decisions on that. Now, not just red candles are bearish. You can see here that this is actually a bearish candle as well. If we kind of see what's happening here, we have an open right here. Now the open is the lower price point because this is a green candle, so we know that the close obviously has to be here. But during this time period, buyers pushed it all the way up to the top. But during the time period, sellers came in and forced it from this high level all the way down here. So even though the close was above the open, so the candle is green, what we're seeing from the body right here is that sellers came in and forced the price way lower. And so that's what I would consider bearish price action. Not just the color, not just the price move, but the price action. Where is the action going? And we can see that sellers came in. The complete opposite of this is bullish price action. This is obviously very bullish. You're never going to get a perfect candle where it's just opening at a price and going up. So yes, there were some sellers here, but that didn't matter. Buyers came in and the whole thing just came up. You obviously have 1 into 2 into 3 candles here. Bullish price action over time with the candles getting bigger. So not just is the price going up, but the volume and the amount that the price is going up is rising each time. And that's obviously very bullish for the price. And with bullish price action, yes, that can be in a red candlestick as well, because we have a red candlestick here. So we know the open was here, the close was here. Sellers came all the way down during the time period and pushed it way down to this price. But also during this time period, buyers came in and pushed it almost all the way back up. So if we know that buyers are coming back in here and pushing the price up from the low, we can predict that during the next time period, potentially that buying is going to continue and actually pushing the price back up. So that would be bullish price action. Yes, a fall in the price, but the action given by the candle is bullish. You can go over to a specific chart and see many examples of this over time, where you can see that even though this was a green candle right here, during this time period, there's some bearish price action right here. So we're going to go through in the course trying to identify these and what they actually mean over time. Candlesticks can only really tell you four main things about a price. Either it's bullish, bearish, indecision, or continuation. So bullish reversal patterns. If you're seeing the price come off, can a candle actually identify the specific time in which a bearish price action moving down is going to reverse? And it's not just price that tells us that, but it's also the candlesticks and the volume and the amount of the move. So bullish price action can potentially indicate when bearish price action has finished and we're going to reverse into a bullish move again. Opposite for that is bearish. When an up move is running out of steam, we're seeing it kind of run out of steam and the amount of rises is slowing over time, that's potentially bearish. Can we use candles to identify that? Continuation patterns mean that the trend that's happening to the upside may even continue further or even get stronger. And if we can identify those, then we can ride those trends. Indecision patterns mean that the market is in equilibrium. Buyers and sellers are kind of meeting in the middle, pushing the price up and down and not really knowing where they're going. And so there's very big sticks either end and the body itself is in the middle. It's kind of indecision. And so for that, you may just want to hold off any trades. I'm going to go through a load of simple candlestick patterns before getting into some more advanced context of how to actually use candles when you trade. One of the most simple patterns, bullish reversals first, is the hammer pattern. Why? Because it looks like a hammer. This indicates a bullish reversal after the price has been moving down. So you get these bearish candles, then you get this right here, which is a bullish hammer. So every price action, think in your mind what this candlestick is telling you. Like I said, we have an open here, which is obviously below the close because it's a green candle. So we know the close is up here. So think about it. We opened at this low price. Sellers sold us off the whole way down. But during this time period, bulls moved in and took us not only from the lows, but all the way up to new highs during that time period. Why is this a bullish reversal? Because we have to think that potentially sellers that push this price right up from the floor are going to continue. Because remember, they don't trade on a 5 or 8 minute basis, which we're looking at the candle. So we can use these candles to predict that those buyers who came in right here potentially are still going. And so we can use our time frame analysis to try and predict them carrying on and then actually ride their trades into a bullish move. Can we see a hammer on a specific chart? Yes, we can. Now, in the real world, hammers and candlestick patterns aren't perfect, but you can identify them pretty easily. You can see right here, this is a move down, so a bearish move, and then we have what I would say is a hammer right here, right? Sellers came in, forced it down, but then buyers came in and pushed it up again. So we got one green, a kind of bearish hammer here, but you know, kind of to be expected. And then we actually ride this move all the way up to the top. So seeing these hammers right here, you can see another one almost actually coming off of a low anyway. You can see all of these all the time that they actually precede some moves that come in and move to the upside. So that's what we actually want to see. An inverted hammer is a similar sort of thing where you're looking at a reversal from a downtrend. So you have the downtrend here and you're looking to for a green candle to print. Now you can see that buyers pushed this right up during this time period. Sellers did come in, but they haven't been able to force the price lower into a red candle. And so what we can glean from this is that potentially buyers are now outnumbering the sellers. So rather than printing yet another red candle, we've actually flipped into a green candle. And then we can try and think, well, is that going to continue over time? And if it does into the next periods, then you may see somewhat of a move. There's a couple of versions of this, and the inverted hammer doesn't print very well in reality, but you can definitely see a few here. So this candlestick right here, we had a couple of moves down, and then obviously we have the green candle here, where even though the price was forced down from the high, the green candle is now printing, and so buyers are moving in. We can also see this one here, a few red candles and a sell-off. And then very clearly what you can see here is that even though the price came off from the high, we've definitely printed a green candle. And so buyers are taking over. So potentially that may follow on into the following candles. Another example is 3 white soldiers, essentially when you have 3 candles in a row. So yeah, you're getting the downtrend, but we can just see that that downtrend has finished. Now, sometimes with three white soldiers, you have 3 candles in a row. What you might get is just a small sell-off here, but then a continuation. So when you get 3 candles in a row that are all going in one direction and seem to be moving in the same way, that obviously indicates that the trend is quite strong in that direction. Now, sometimes what you may get, as you can see here, is 3 in a row, and then just a pause, and then a big move. And you can see that once here as well. So you have 3 in a row, you have a pause, and then a big move. So with 3 white soldiers, what I'd be looking for is a downtrend that has very clearly reversed, and that may be moving up into just a completely new uptrend. So again, trying to time the reverse of a bearish trend into a bullish trend. A bullish harami is a great example of a very bullish trend change, because the opening price of the bullish candle is way above the closing price of the bearish candle. So the bearish candle has an open and a close, obviously way below that. And so from that time period into the next one, you get a jump in the price. And that means that sellers are potentially finished, buyers are coming in, and they're being quite reckless with their buying. They're just buying at any price. And so the price moves right up between candles. And that suggests that buyers are in and potentially will force the price higher over the next few candles. These are quite rare because the time between a candle, when you're looking at short time frames, just one candle into the next is a second. And so you're not going to see huge discrepancies with these prices. They're very rare in the real world, but what we're looking at is a good candle where you can see potential downtrend has changed. It doesn't work out every time, but sometimes it does, and you can see that that obviously indicates bullishness into the next candles. Next up is bearish trend reversals and candlesticks that show us that an uptrend is about to stop. So essentially what we're looking for is the price action to show us that any buyers are getting crowded out by sellers. And if they are, then we can predict that that's going to move on into the next candles. So what we're looking for is, buyers to send things up, and then that price action to get whacked by sellers. And that can be seen very easily in something like a shooting star, where you're seeing the price action move up, but then get shorted by sellers and essentially moving that candlestick down. That could potentially follow in to the next candles, and shooting stars happen a lot, and you can see one right here. So this is a good example. Now this isn't a great example because we have a big move here, but what you can definitely see is that the price has been tried to been moved up by buyers right here, and it's just got rejected. And so not only has the price action that forced the price up been rejected up at this high price, it actually gets forced down lower into a red candle. And you can see many examples of this over time that kind of precede moves. So you're looking for a move up and then a candle that is essentially whacking that down and saying, you moved up, but we're whacking you down. And then you want that to move into the next candles. And if that does, then there may be a downtrend coming. Again, sometimes it doesn't predict that, but what you really want is the candle to show after an upswing that buyers are basically being crowded out by sellers at that point. Hanging man is another bearish pattern. Once more, we're just looking for a bearish price action. So we have an open and a close here. What you can see is that the price gapped up, but then sellers came in and forced it much lower. Buyers came in again, but they couldn't force the price up. And so that obviously means that there are more sellers than buyers, and it's potentially turning from a kind of bullish move down, potentially bearish. Now, these again, in the real world don't happen that often, but you can see versions of it. So this one right here, a big bullish move up, But then this is the candle where, you know, the bullish move stops and the buyers actually get taken over. And so when you see that, obviously that is something that you can potentially use to try and predict what will happen in the next few candles. A really important type of candle is the engulfing. These can be the bullish or bearish, but these can tell you the end of a certain direction of trade moving into a new one. And so they're actually very easy to spot. The trade around them can be really noisy, but they can really tell you where the direction of trade is going to trend over kind of the medium term, depends what time frame. But an engulfing, very simply, is when you have a candle. Now it can be any candle, it can be a down or an up candle, it doesn't really matter. But when you have an engulfing of that candle, it can really tell you where the trend is going. So a bullish engulfing would be when you have either a green or a red candle here, right? But then you have a engulf of that candle, right? So that means that it's just absolutely insane where the big, you get, you know, it's a really big move, right? So let's say we've been having kind of a move down, right? And you've been having red candles, and then suddenly you get this real wallop, this kind of God candle, right? So it just completely changes the direction of everything. Now, this usually happens on news, right? Otherwise, why would that happen? But a big move that changes the direction of trade is with an engulfing, may signal that things have just completely changed. And so even though it may be noisy around the trade, it may signal a trend change. What I mean by noisy is often when you get these big engulfings, you'll get like a couple of candles either side of it that are kind of small and maybe to the downside as sellers come in. So it can be noisy to trade, but it really can change the direction. A great example of that is right here. So you can see we've had huge engulfing candle right here. Okay, so it engulfed the previous one and then some down, you know, some down moves. But this is the engulfing right here. As you can see, this entire candle down move just got absolutely wiped out, and then some with this green candle, and it actually went up here as well. So this isn't an engulfing as such, this is just a continuation of this one candle. Now if you looked on a longer time frame, these two green candles here may actually just print as one big engulfing candle, but that tells you that whatever move this happened, or whatever news or events that was, you know, bringing the price down in this direction has changed, and so you get this engulfing. Now what we can suggest by that is that essentially the trend may have changed. So if you like zoom out a little bit, what you can see is sellers came in again, and this is the noise around the candle. So when you get such a big move, people think that essentially it has to revert to the mean a little bit. So in this instance, with a sell-off, with a big bullish engulfing, you do get a little bit of a sell-off. But then really key as well, and we're going to get onto this later, is the trend of the chart, which is a higher low. So this is obviously printing kind of a bullish move away from this very bearish move. So this really is telling me, one, with this bullish engulfing and then a sell-off, but then a higher low is telling me that, okay, we may be trending up a little bit here. So if you want to time the market, then obviously going long during this sell-off or during the bounce off of this low leads you into a trend upwards. And short-term trading, that's it. You basically get in and out at that point. The next type we can look at is indecision candles. These can tell us one of two things. Firstly, that traders really are just balanced, and so the price is going to move sideways. The other thing it can tell us is that maybe it's a trend reversal. It depends on what happens before. If you get a big move to the downside into here with, you know, lots of big candles to the downside, but then you get an indecision candle, maybe that's telling us that the price is now starting to reverse, or that the trade is actually leveling off and potentially moving up into a different trend. So it depends, but what you usually get is just, you know, a big move up and down, but eventually the open and close price is the same. In the real world, this very rarely happens. You might get a small upside or a small downside candle, but essentially what we want to see is, you know, a move up and a move down, but the open and close price around the same level. You can also get them in the middle right here, which is obviously kind of a perfectly balanced trade, and, you know, neither buyers or sellers are winning. In the real world, you can kind of analyze this with context. So what I can see here is a couple of indecision candles that will show us, you know, where is the price going. So right here is one, and you can see it's a perfect indecision candle really, and so you can't really glean too much from that, apart from, you know, what's happening in the general trend of trade, and we're going to get onto that a little bit later. You can see some more indecision candles here. So again, traders really don't know what they're doing. You've actually got your downward move here, but the next candle is also an upwards move. But the wicks are very, very long and the bodies are very, very short. So what traders are really telling us is some traders are moving in, trying to buy, some traders are trying to sell, but really the market is kind of doesn't know what it's doing. It doesn't know where it's trending. You can see if you look at the other candles, you can see there's no real trend here, right? So real indecision in the market. Most of the time, you might just want to step back from trading here until you get maybe a kind of heavier trend that can influence if you're going long or short, or potentially this is actually a good kind of breathing space for the trade. Like if you look out a little bit into a longer term trend, you might actually see, well, I think that the price is going to be bullish and moving up. And so during these periods, you may want to accumulate waiting for the next trend up. So it really comes down to more contextual about looking at trends and looking at the wider market in general. And so that's what we're going to move on to now. So yeah, there's a few things that we must know with candlesticks. We must know what they tell us and how we can use them to trade, but we must also know their limitations and also use them with some, other ways of actually getting real context of the market. Because when you're trading, the real thing you need to know is where is the trend, right? If it's an uptrend, you definitely don't want to be going short. If you're in a downtrend, you definitely don't want to be longing and going long. You're just going to get absolutely wrecked. So really what you want to know is, where is the trend? What's the context of what I'm trading? Am I going with the market or against the market? And then you can really be specific about the candles to give you a little bit of very specific entry price triggers. So you cannot trade based only using candlesticks because it's going to give you so many false flags. If you're wrong about the actual trend of the market, then you're going to be on the wrong side of the trade no matter what the candlestick. And candlesticks can give you a good entry price, but they're going to be very difficult to use if you're just using them and not using other contextual factors. For example, the market trend, I think it's the main one. So we're going to look at some ways to kind of understand the trend and using candlesticks with that. Price action is so important as well in terms of support and resistance levels, trend levels, where the price may get to. They're the entry triggers, and you can use candlesticks as your entry trigger with price action and the market trend that you do. Trade quality as well, like candlesticks really, if you're just using candlesticks, can give you really poor trade quality, like I said, because if you're not doing some trend analysis and getting in at the right levels, candlesticks can be very noisy and they can give you a good entry, but it doesn't tell you how long the entry is going to be or if you're in at the right price. And so really important to kind of look at trade quality, price action as well. And then something I use way more than a lot of technical kind of traders, fundamental analysis and news, reading the actual market, understand the macro events that are shaping which way the market is moving in general. So all of this you have to use in conjunction with candles. For me, candles give you the entry point and a really good contextual part of the trade when you want to get in. So we'll look at that now. So here's my 4-point plan of using candles and also giving them context, and every trade can follow this strategy. The first one with candles is to, before looking at the candles, try and ask yourself, what is the trend? So what is the trend for the price? Essentially, you have 3 main trends, which is a downtrend, an uptrend, and then a consolidation. And we've seen the candles that show us that. So that's the first thing. Before you trade and use candles, what is the short and long-term trend? So what we can do here, and a really key tip, is whatever you're trading with candles, if you're trading on the 1 hour chart, right? So each candlestick is 1 hour long. To get a longer term trend, what you can do is move up in your time frame a little bit. So instead of having a 1 hour trend, 1 hour candlesticks right here, let's just move up to the 4 hour. So for example, it's going to give you much more context. If I'm trading, if I'm coming into the market, right, looking at this and saying, you know what, this is an uptrend, I'm going to go long, and we're going to, ride this uptrend, which we've seen is possible. And even if you bought here and sold here, you would have won, you would have made a good trade. But typically traders, especially day traders, often trade with the trend because it gives them a higher probability chance of actually, winning more than losing. So that's kind of what you're doing with day trading. So what you want to do, instead of just looking at this and saying, this is an uptrend, right? Because if you were here at this level, you'd be seeing this small uptrend and thinking, okay, well, I'm going to go long, and I want to follow this trend. We're in an uptrend, but is going long the right thing? So what we want to do is come over to the 4 hour. I'm going to reset the chart like this, and now things are looking a little bit different. This is our uptrend right here, but look at the context of it. Okay, it looks like a pretty big down move. So what I want to do is just look at the day chart as well, and this was our move here. Do you want to be going long during what is essentially a really large downtrend? Probably not. And so before you even use candles, which they're not going to tell you the trend, get the trend on here. So look at longer term candles and then put some moving averages on here. So, I've got a 20 period moving average, 200 period moving average. The price itself, as shown by the candles, is underneath both of these moving averages. If you don't know what moving averages are, check the videos in the description. It goes, through all the basics of that. You can put them on via your indicators. A moving average just shows you, the average price over a time period. And so the actual price is way below these. We're definitely in a downtrend. So I can come back to my 1 hour day trading chart, have a look and say, you know what? We are actually in a macro longer term downtrend. And so going long probably isn't the best. Even though that would have been a good trade, you're going to have to look at probabilities. So number one, absolutely is, here is to look what the trend is first before using candles to actually go and enter. The second thing I would do is look at longer term price patterns and price action to then guide me as well. So what I mean by that is, can you identify a specific trade pattern or trend to trade? So we can go with the first point, which is what is the trend? We know we're in a downtrend. Then what I can do here is look at a potential area that I want to trade. And if I'm considering that we're in a downtrend, what I want to do now is try and sell rallies. So rather than going long and looking for some bullish divergent candles to go long on, what I'm really looking for is two things. The first is some bearish divergent candles because we're in a downtrend. The second thing is looking to see some consolidation at resistance levels. Now, I know I'm touching on a little bit different aspects here and not just candles, but you have to use all of this technical analysis in conjunction. So, a lot of these concepts I go over in those free videos below. I have a crypto course that goes over these as well. It's up to you which one you want to use. But what I'm going to do here, you can see I've got this drawing on a chart right here. So what I'm actually going to do is show you how this chart pattern is bearish. So we're in a bear market as of making this video, and we're looking at a bearish price move. Remember, we're in a downtrend as we've seen, and I was looking at this pattern as resistance right here, and basically an ascending channel or ascending wedge, as you can see here. So this is the top of the ascending wedge, and this is the bottom of the ascending wedge. Obviously the bottom side is ascending. That's actually a bearish pattern, especially in a bear market. And so I'm looking for that bearish pattern to play out. And what I'm doing is looking at key levels of support and resistance to come in and actually trade at. Now that key level is really easily found. You can just see resistance on the chart. Can you see where the chart moves up and gets rejected once here? This is definitely a rejection. You can see that. This rejection. So I'll do that. And then there's another rejection that I'll put on the chart here. So there are two rejections. So what I'm trying to do is think, I know I'm bearish because we're in a downtrend, and I'm going to look for the price to basically get up to the resistance again. And at that point, because I've got into a bearish stance, what I want to do is look for candles that show me the bearish move down. So a bullish engulfing, something like that, a hangman, something like that, right? And we actually got a few here. Now, there's a few areas that you could have traded. The first one was an indecision candles that you can see right here. The other is simply just a bullish engulfing at this point here. Now, you can actually go back to the 4 hour and see those as well and see the difference in candles. But what you want to do is get obviously the way that you trade first in terms of bullish or bearish, and then try and look at candles. We had a bearish engulfing here. We had a few indecision candles here at a resistance level. And so they're kind of telling you that they're the areas to get in at and potentially put trades in at. The next thing, once I've found the candle actually moving into an area of the chart that you would want to trade, is to look at a potential risk reward ratio. What I mean by that is when you go into a trade, it's not just the candle that tells you where you get in and out at, it's the chart in general. So we're going to use candlesticks again to kind of give us an idea. So what you can see at this level, let's say this is the level that we want to get short at. So we're going to short the market because we're in a downtrend and we've seen this resistance level up here. Now we want to look at levels where the chart consolidates around, and that's where we can place our trades. So I'd go into a long position, short position, sorry, and place that in around this level, because that's where you're looking to trade at. Now what you want to do is look at previous candles and see where there is a resistance level, a very key kind of resistance level in the chart previously, because where the chart moves previously is where it potentially could go again, and that's the levels that we play off. So if we're looking at resistance levels, if you're going short at resistance during this, then what you're looking at, you go back in the chart, look for a candle where there's either a consolidation or a resistance. We're on the downside, so we're looking at resistance. This is a resistance level. You can see that those candles right here are telling us that the price moved up and then got rejected at this level and moved down. So that is a resistance level for us. You can also see 3 or 4 candles here where the price consolidated and was indecision. So I'm going to use that price level as an area where I think there are potential sellers and resistance levels. And so that means that I can place my stop loss there. So I take the short position calculator right here, and I just bring my stop loss to that level. Now the potential win, again, this is going into some different concepts and you have to use candles here, but all I can look at is previous candles where there's been support. Now we're going to the downside, so we're looking at support, previous levels where the price has really bounced off and got a lot of buyers, because that's going to tell me that at that price level, buyers may come in again. And so when you're trading, you're going to want to place your, take profit. Now we're going short, remember, so it's opposite if you're long, but we don't want to place our stop loss anywhere near there. We're going to place it a little bit above because we don't want to wait that long. So that would be a risk reward ratio in terms of using candles to find out where you can go in, where your stop loss is, support and resistance, and where potential take profit is. Now, as you can see here, this risk reward ratio is 2.69. That's a fantastic ratio right there. So that trade would pass in terms of potentially getting put on. Now we can use candles to decide where to enter, and what we can do is look for levels that we are familiar with. So we can use the candlestick patterns like bearish engulfing if we're going short, or a hangman or something like that, or you can just look for areas of consolidation, which also mean that after the consolidation, some big move is going to take place, and you're essentially looking at the trend to decide which way that would be in terms of if you're going long or short. So there's a few ways you could trade this. The first one is what we're seeing is a few indecision candles around here that you might want to go in at and place a short trade at if we're going short. You can see indecision here as well, where we're just trending and we're just kind of waiting for the breakout of a chart pattern. So sometimes I like to go in with consolidation patterns like this with indecision, because that shows me that we are consolidating before a big move. So you can put your trade in and then obviously wait for that big move to happen, which is like a position trade, or depending how long it is, a day trade. Or you can wait for a specific candlestick to actually enter that trade. What I mean by that is, for example, here we saw a bearish chart pattern, right, which is essentially mostly a bearish engulfing. It's just a down candle, right? It's just a bearish candle. Or out of here, right at the very end of the chart pattern, we saw a really bearish candle, right? It's not even like a shooting star or anything. It's just an outright bearish candle where it's just a large bearish engulfing, and that's right at the end of the chart pattern where you'd expect that the chart pattern in this instance breaks down, and that's exactly what it did. So the type of trader you are will determine where you want to go in, whether you want to get in around consolidation or whether you want to wait for these specific candlestick patterns to actually enter. Now what I would always suggest is looking at the general trend as well, looking at the day in this instance, 4 hour, 1 hour, just looking at kind of trade and where it's going. But you can either use a specific pattern like we've seen in this video, or that consolidation. But the key is getting the trend and direction of trade as well, and then waiting for whatever candle you decide to enter to actually enter the trade. So a recap here on candlesticks, what they're good for and some of the limitations of them. Candlesticks are very specific price action identifiers. So they can be used in conjunction with other techniques to understand when and where to get in and if the trade is moving in the direction that you want. They absolutely cannot predict the price longer term. Nothing can do that apart from large kind of macroeconomics that you can also study for longer term investors. That is, for short term traders, candlesticks are more important. For trade entry, you can definitely get specific trade and exit points from candles and obviously use them to confirm or deny some of the trades that you might want to get into. They need to be used in conjunction with the other techniques like other technical analysis, fundamental analysis, trade patterns and everything like that. All of that is in my crypto course, and it's an entire day trading and investing course. It's like 200 plus videos. So I'll leave that link in the description if that's interesting. If not, I've got loads of free videos on day trading as well. And I'll leave those. They're totally free on YouTube in the description as well. Everything down there. I'm James with MoneyTG. Cheers for watching, and I'll see you in the next one.